protecting Main Street from Wall Street. It's Chris Hoffman with Money Unleashed.
How much money do you put into your checking account from work on a month-to-month basis? It has a high probability that with your investable assets, we can replace that paycheck.
It's time to put you back in control of your money.
You've worked for 35 years. It's time for you to not stress. It's time for you to enjoy and live the retirement you want to live.
It's Money Unleashed with Chris Hoffman.
Welcome into the Money Unleashed podcast with Chris Hoffman of the Hoffman Financial Group. New episodes come your way on Mondays and Fridays, so make sure you're subscribed wherever you get your podcasts. Now, Chris, I'm going to hit you with a big number.
All right, bring it.
The Great Wealth Transfer refers to an estimated $68 to $84 trillion in assets that baby boomers are expected to pass on to younger generations and charities by 2045. Merrill Lynch, though, has even upped that number to $124 trillion by 2048. So let's just call it a substantial amount of money about to change hands.
Yeah, well, let's not tell my kids that number. I don't want them expecting anything close to these averages. But you know what that points to? That points to people's number one fear in retirement of running out of money. They're hoarding it. You worked hard for 30 years plus. You earned the money. Your church, your charity, your kids didn't. Whatever's left over, give to them. But that is a massive amount of money. Now, some of it is based on recent stock market highs and growth and all that stuff. But I had no idea it would have been tens of trillions, if not hundreds of trillions. That is a big, big number. So it's two things. It's fear of running out of money in retirement and not having a solid financial plan to guide you. I think the other thing is obligation. Why do we as parents feel obligated to continue to protect our kids financially? We protected them physically. We raised them. We fed them. We clothed them. And now they're in their 20s, 30s, 40s. If we pass away and they're in their 50s or 50 years old or 60 years old, we feel obligated to leave them money. Well, I don't think it should be looked at as an obligation as much as here's what your parents are able to do for you in addition to giving you the house and the cars and everything else. But that is a very daunting number. It's $124 trillion being left to churches, charities, and kids. I'd like my retirees to use more of that money for themselves.
Yeah, you definitely want to be able to use it for yourself. The other option is, you can't give it to your kids or the charities that are close to you, but the last option, the one that nobody wants to trigger or nobody wants to point at, that's giving it back to the government. Nobody wants to do that.
Yep.
So over the next 20 years, we're going to see all that money passed down, whether it's 68 or 84 or $124 trillion over the next 20 to 23 years, according to Merrill Lynch. It just got me wondering, what's the best way to do this? And maybe more to the point, what's the worst way to do it? Because one thing we can definitely count on during this handoff is the government is going to be there as more than a casual observer because there are taxes to be paid. So could you walk us through the best way to give and receive this money because no one wants to see more of it going to Uncle Sam? Yeah.
So you can gift your heirs, your kids in this case, let's talk about them. You can gift them close to $14 million each. So for high net worth clients, and obviously there's got to be some high net worth ones in this,
I would imagine,
in the $124 trillion calculation, but it's basically 14 per spouse. So combined, you can leave your kids up to $28 million. So anything over that, you've got to protect and take it out of your estate. Irrevocable trusts can do that, where you can contribute that $14 million up front, and all of that growth would never be taxed to your heirs. So that's a high net worth scenario. A more realistic scenario is avoiding taxes through taxable accounts being invested in stock portfolios. So if you have $1 million, not in your IRA, but in just taxable money, you invest that million grows to $2 million or $3 million. Your heirs, your kids will not pay any taxes on those capital gains. They get a stepped up cost basis on the date of your passing away. So those are some tools we can use to kind of shelter and box out the IRS and the government from taking your hard-earned money. And obviously you want to spend it. So enjoy it. Be aggressive in your spending in the first 10 years. Not aggressive meaning sell a bunch of stock if the market's down, but have your financial plan built more aggressively on the front end the first 10 years, because that's when you're youngest, healthiest, mentally spry, enjoying your life. Go and visit the kids and the grandkids and go take the trips and enjoy your hobbies. Do that in the first 10 years and spend a little extra. Let's not leave $124 trillion to our kids and have the government walk away with 20 trillion or 30 trillion of it in high net worth. Let's not have the government force our children to take out all of our pre-tax IRA money. The Secure Act requires that kids remove 100% of the money out of an IRA within a 10-year period of time. That is potentially going to be as big a tax bite as estate taxes. If you're over $14 million apiece, I think the estate tax on that is roughly 40%. What if your child that inherits your IRA is a high wage earner? What if their total tax burden every year is 50%? Now you've given them not $1 million, but $500,000. So let's organize a plan around spending money that you can avoid taxes on in your lifetime, but also avoid passing it to your heirs in a tax-damaged environment. We don't want to give anybody a tax trap or a tax time bomb. We want to give them free and clear money to use, and that's the money that you've earned that you want to pass on to them. We got to keep the government's hands out of our pockets.
No doubt about it. And to say this wealth transfer is unprecedented would be putting it mildly. There's also been a trend, a growing trend, to give while living rather than simply leaving it behind. Regardless of the type of money, the type of account, and when the recipient gets that money, those are all factors, but how the money is taxed, as you just mentioned, Chris, is something you have to account for. If your child is in their highest wage earning years when they receive this inheritance, it could really create that tax time bomb, couldn't it?
Yeah, it can. And you just brought up something that is equally important in our discussions with our clients about financial planning, and that's how much of your pre-tax IRA are you going to be required to pull out? Now, some of you need it, right? And it's fine. You even need more income than that. But for those of you that have $2 million in a pre-tax IRA, if you're required to pull out 5% of that, that's $100,000 a year that you don't want to get taxed on. So what about taking a portion of your RMDs and gifting it to a charity or a church, somebody that's tax beneficial? You don't pay any taxes on it if you gift it, and they get a tax-free benefit. So there are some strategies around how to work with your taxable IRA money that can avoid big-time income hits altogether.
Well, that certainly is good to know, and I'm sure people are happy to hear that there are those strategies there. So why don't we spend a little bit of time walking through the process of putting together what I would define as a tax strategy for folks.
Yeah, and so this will expand our tax strategies into legacy planning. Oftentimes, financial advisory teams, and there are several different layers that you should expect your financial advisory team to do for you. A lot of those advisory teams start and stop with portfolio management only. And then when you come in to visit them, they give you the report. We did this versus that. That's just one step in the process. Distribution planning, income planning involves how do we handle the pending tax issues? You've got three types of accounts, folks. You've got taxable accounts that if they're invested in stocks, you get capital gains. I would want to use the dividends from those as an income stream for my clients. Possibly, if we can afford to do it, leave the principal and the growth of the principal to your spouse and your kids because they get a stepped-up cost basis. You have tax-free investable money, Roth IRA, Roth 401k. That should be used as an augmentation to the other income streams to keep the tax trap from collapsing on us. So that's our ace in the hole. That Roth money, that gives us the ability to decouple from the IRS even with our taxable IRA money. And that's the third component. It's tax-deferred IRA, where most people have the majority of their money that we need to take out or move or convert in small pieces, either early on in retirement or before retirement, to make sure that you avoid the tax time bomb for your heirs.
That other little factoid that kind of goes with the highest wage earning years, where receiving a large sum of money could bump you into a different tax bracket, is depending on what type of account that you're passing along, they have a limited amount of time to drain that account as well. So not only are you dealing with more money than you're used to dealing with, but you're also working against the clock, aren't you?
Yeah, and that's a great way to look at it. The tax time bomb is a 10-year time bomb. Some period in that 10 years, you're going to have to take all of that money out and pay taxes on it. And that's not something you want to hand to a child from my perspective. You want to use up as much of your pre-tax IRA in your lifetime as you can and preserve your taxable money and your tax-free money to pass on to heirs. The Roth 401k, the Roth IRA, it's the one thing the government did us right on. The problem is it takes financial discipline. It takes financial discipline to choose a Roth 401k over a standard 401k pre-tax. And I know it's tough, folks. I know you're under stress and pressure and some inflationary pressures and some cost of living pressures, but if you can at least balance some of it, don't do 100% in Roth, maybe do 50% of your contributions in your Roth 401k. It will pay dividends in retirement when you don't have to pay that tax bill, and then your heirs, they benefit from not paying that tax bill on Roth money as well. So the key here is, how do we prepare you for what works best from tax perspectives? And that is a missing ingredient in most financial plans. We will do a deep dive into that. We will explain each bucket of money, each distribution we send to you in an income stream. You'll know exactly which bucket it's coming from, why it's coming from, and we can toggle it year over year over year. So if you've got a question in your own mind as to how much you're truly worth and how much your financial life can generate for you after taxes for the rest of your life, that's a great exercise for us to walk through together. Just call us at 404-341-6767. Book an appointment. When we call you on Monday or Tuesday to confirm it, just mention that you've got tax questions and you want to understand what your potential tax burdens may be, and you want to avoid the tax time bomb. We'd be happy to assign you to an advisor and begin that discussion on how to avoid taxes in retirement and avoid taxes on your legacy.
A critical step in your full financial plan is accounting for taxes, and there's no cost whatsoever for you to get this kind of planning in place, for you to identify the type of tax strategies that would benefit you and benefit those in your legacy. 404-341-6767 is the phone number, 404-341-6767, or sign up online at unleashyourmoney.com. Chris Hoffman is an investment advisor representative of Brookstone Wealth Advisors, LLC, a registered investment advisor and affiliate of Brookstone Capital Management, LLC. BWA and Hoffman Financial Group are affiliated under common ownership. Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interest of our clients and to make full disclosures of any conflicts of interest. Please refer to our firm brochure, the ADV 2A, page 4, for additional information. The Hoffman Financial Group and WSB are not affiliated. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. This information should not be considered tax or legal advice. Individuals should consult with a professional specializing in the field of tax, legal, accounting, or investments regarding the applicability of this information for their situation. Any client experiences discussed during the show are unique to that client. They are not meant to imply or suggest you will experience the same results. Past performance is not a guarantee of future results. Investments will fluctuate, and when redeemed may be worth more or less than when originally invested. Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims-paying ability of the issuing company and are not offered by Brookstone. Index or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract. Please refer to our firm brochure, the ADV 2A, item 4, for additional information. Hoffman Financial Group is not affiliated with or endorsed by the Social Security Administration or any other government agency. Insurance licensed in Georgia, number 163546.